Hi there. In this video, we will wrap up what we discussed in the previous two videos. If you remember, in the first video, I talked about the difference between accidental fraudster and the predators. And then I try to explain the definition of fraud as a complicated fraud that might have a collusion among different individuals or organization, either in one place or in multiple places, and even in multiple countries. And then we start to go through the different types of complicated crimes, such as the money laundering, such as drug dealer, terrorism support. And then in the previous video, I explained more details about how money laundering can be hidden into legal activities like insurance, like casinos, like gambling. All these businesses might be legitimate from the outside, but from the inside, it might have money laundering as part of the income. And then I start talking about the tax evasion and explain the difference between tax evasion and tax avoidance. Then bankruptcy fraud, which means presenting a false claim to the government about bankruptcy to take advantage of that and try to hide the assets from the creditors. And then we discussed in brief the different types of securities fraud, such as Ponzi scheme. And we said Ponzi scheme starts by taking the cash of the new investors to pay for the return of investment to the old ones. And then we went through all the different types of crimes that might happen with the securities, whether it comes from the investor side or the management side or the broker side. And I ended up my presentation last video talking about mail fraud and wire fraud. Mail fraud, where we use the US Post Office Service to mail some wrong documents to a different party, such as mailing the incorrect tax report to the IRS. Although this is tax evasion because it's a crime, but also using the US mail to mail the tax return to the IRS, this can be counted as mail fraud. Same thing for using radio or broadcasting for making a fraudulent case. In this short video, I will talk about the different acts that has been issued here in the US, mainly 6 acts that fight against the fraudulent. One of them is RICO. The other one is Patriot Act. The third one is the Bank Secrecy Act. Then the Foreign Corrupt Practice Act. Then Securities Act that has been established when the Securities Exchange Commission started back in 1933. And finally, we will talk about UK Bribery Act. The first one, RICO Act, that has been issued in 1970s, they give authority to the investigator to examine any business that might be involved in organized crime. So the target of this act, mainly organizations, not individuals. And they are dealing in dirty money and they need to find the source and make confiscation of the assets or the cash that comes from illegal activities. The result of that, making confiscation of the cash or the assets to stop this kind of illegal activity. And here we come across conspiracy because for organized act to happen, usually there is some kind of agreement among certain individuals or organization to go into this act, and this falls under conspiracy. What are the elements that should happen for conspiracy to be counted as illegal act? Number one, there should be some kind of agreement. So if 2 or 3 organizations or individuals, they came together, they should come up with agreement and intent or state of mind to commit a legal act. And there is some kind of inclination that they show it either by action or by documents that shows that those people are inclined to commit this act. So there is an agreement with a state of mind and evidence for conspiracy to be counted as illegal. The second act that has been issued in the US is the US Patriot Act, back on the 9/11 when the terrorist attack happened here in the Twin Tower. And since that time, the Patriot Act came to fight against any support to terrorism attack. And good example of that is money laundering. So money laundering for supporting terrorism attack is honestly under the penalty of Patriot Act. And once it is fined, then the cash will be confiscated and any other property will be confiscated under the Patriot Act. The next one, Bank Secrecy Act, and this one is related to handling a huge amount of cash, usually 10,000 and above, without any disclosure, or trying to avoid the tax where the bank might be involved, like having some cash coming from the individuals to avoid their tax payment. What does it mean? It means if the bank is aware of some transaction that has been made by certain individual without clear disclosure to the government, the bank is obliged to report it. Like here, financial institutions maintain adequate record and report certain type of transaction to the federal government. And here, as I said, they report it in a form called suspicious report or suspicious activity report. And they make a form for FinCEN, and I made a copy of this one here. And FinCEN stands for Financial Crime Enforcement Network, that requires individuals to disclose to the federal government any amount of cash is above $10,000. And it doesn't mean that the cash is illegal. It's just the source of cash from where it comes. It might come from inheritance. It might come from gifts. As long as we justify the source of cash, it should be illegal. The US banking system actually usually has everything in writing because it's a regulated industry, and most transactions and their backup documentation are captured on microfiche or some form of electronic imaging. And usually here the banks, they handle all the transactions of cash either through legal transfers or checks, and the checks, they usually have the routing number and the account number to validate the transaction. So these are the three acts that has been issued, whether a racketeering law or RICO Act, or the Patriot Act for the terrorism attack, or Bank Secrecy Act for transactions that has a lot of cash. The Foreign Corrupt Practice Act, it was issued in 1977 to fight any kind of bribes or illegal income that is provided from the corporation to the governmental authorities to take some kind of benefits. And this happened during the 70s when the US companies were trying to expand in different countries. And then they start to study the economic system of different countries, and they find to get permission to start their business in the other countries, they have to bribe the governmental official in the other countries. But later on, this act has been denounced by the federal government, and they require the board of directors to initiate internal control system to avoid any kind of bribe the companies might provide to the governmental officials for the sake of getting permission. It's Foreign Corrupt Practice Act that is meant to control the actions of the US corporations mainly with governmental authorities outside the country. Securities Acts, and these came out back in 1933 and 34 to regulate the trading of shares. If it's initial public offering, like issuing shares for the first time, it's regulated by 1933 Act. But if the shares are in the market and needs to be traded, then it's regulated by 1934. So the initial public offering has one act to regulate the procedures. The trading among the brokers and investors has another act. Then there is another act came out in 1940, the Investment Advisor Act, which is providing clear advice to the investors. Investment Company Act, which are the brokerage firm, they come out in the market to help the investors making the right decision. Sarbanes-Oxley Act, I am sure you might remember this one maybe from other classes, either in business law or accounting. This act came because of the collapse of the electrical company here in the US, Enron. And the Sarbanes-Oxley Act came out to put pressure on the executive management to set up internal control system. And they put pressure on the auditors to be regulated by PCAOB. So PCAOB, the Public Company Accounting Oversight Board, they come to the audit firm maybe once every 5 years to check their quality of audit for the public companies. For any audit firm to make auditing for public companies, they have to get license from PCAOB and they have to follow Sarbanes-Oxley Act provisions. And this came, as I said, to protect the companies from false attestation or auditing by the audit firm and make sure the financial statements are correctly audited. The UK Bribery Act, and this one came in 2010, introduced to update and enhance the UK law, the British law on bribery. And here they created 4 offenses: either offering or promising or giving an advantage to a certain individual without any right, requesting or agreeing to receive or accepting an advantage, then bribery of a foreign public official, similar to Foreign Corrupt Practice Act, and failure by a commercial organization to prevent a bribe. And the last one, applying to both UK companies operating abroad or to non-UK companies that operate with a presence in the UK, facilitating the payments are illegal under the UK Bribery Act. So to make things clear, giving and receiving bribes or advantage in any jurisdiction, whether in the US or UK or any regulated companies in Europe, this is denounced and it counts as a fraudulent act, and most probably it's very complicated because we cannot easily find out this kind of bribe. It might be hidden under different expenses and the fraud examiner has to search for it. I hope you find this short video is useful. That gives you a good briefing about the different acts that have been issued to fight against fraud. Thank you. Bye-bye.